Let's look at the golden growth model. Why invest in dividend paying stock? It's always good to recap the foundation concept. Okay? And when we think about dividend paying stock, we are looking at often mature consumer staples companies. Right? Consumer staples are things that we need, whether the economy is booming or whether we are in a recession. So we need soap, shampoo, uh, and everyday uses that we need for the home, right? So in the case of Johnson and Johnson, right, we can see that the number of consecutive years of increasing dividend payment, okay, is almost 60 years, right? Pretty much the same for Procter and Gamble. Clorox, more than 40 years. Walmart, more than 40 years, right? So not only are these companies paying dividend, but they're also increasing the dividend. So therefore, as an investor, we may want to have some of this in our portfolio. The advantages of dividend paying stocks is that these dividends are cash flows. They are comparable to coupon payment for bonds, right? So if and when the bonds are yielding at a very low level, and we can find this Coca-Cola, Procter and Gamble paying us a higher dividend, we may want to look at the risk and say, you know what, given the risk, we think it's okay to like move some money out of bonds into the lower yielding bonds into the higher dividend paying stocks. This dividend paying stocks, they are providing us with this expected cash flow in the future. And because they have a long history of paying dividend, a long history of increasing dividend, we can feel reasonably comfortable that they are very good substitute for a bond, right? Having the dividend paid to us very frequently, this helps to protect against inflation. After all, money in pocket is better than money not in pocket. And mathematically, dividend can reduce the volatility of the stock price. When the stock price is falling, given the same amount of dividend, the dividend yield would go up, would make the stock more attractive. At the same time, if the stock price is rising, given the same dividend payment, then the dividend yield will be coming down, making it less attractive. So dividend paying stocks have this boundary. This boundary because investors in this segment are constantly looking at the dividend yield. How do we calculate the dividend yield? Very simple, right? We look at the dividend divided by the stock price. Okay, right. So when the stock price is less volatile, it is generally a plus. Okay, because we prefer to buy a stock that is less volatile than something that moves up and down 20%. So dividends are real payment. What do I mean by this? Well, dividends are actual payment and it's different from net income because net income is an accounting concept. Right? The net income is shown in the income statement, but they are not all paid to you as a shareholder, right? Because the company may choose to retain some of this net income. So we are interested in what was actually paid out, and that is the dividend. Over a long time frame, we see that when we decompose the historical return, dividend yield is a major, if not the most important, component of total return compared to the real fundamental growth of a company, inflation rate, valuation change, compounding. So it makes sense for us to pay attention, right, to the dividend yield when we are looking for stocks to invest in. When we do our research, we need to be careful that we are not comparing apples to oranges, because even in a financial media like this, at times they show the annual index performance of the S&P 500 and the S&P 500 Dividend Aristocrat Index. They are not comparing apples to apples. Why? Because they are only comparing the index, the price, the stock price. They are not including the total return, because the dividend payment here is a lot higher than the dividend payment here, right? So when you do your research, right, be mindful of this and always look for total return comparison. Okay? So here you see that the S&P 500 Aristocrat total return is a lot higher than the S&P 500. Okay? That's because when we look at the total return, we also would include the reinvestment of the dividend. In this diagram here, you see the investment in Coca-Cola over this long period of time, and this is the result without dividend reinvested. With dividend reinvested in the same Coca-Cola stock, the outperformance is a lot better. So for due diligence, we need to go beyond finding the highest dividend yield. Just looking at the dividend yield itself is very risky. I'll explain why. Suppose we look at these companies and we are asked to pick which company we would invest in. One may be tempted to pick Daimler because the dividend yield is 7.1%, and Kraft Heinz 5.7, ExxonMobil 4.9, and Clorox 2.5. Okay? We have to do more research. At the minimum, we should look at the interest coverage ratio and the credit rating. More so on the interest coverage. Because when we pick this 7.1, right, it turns out to be a good decision because the interest coverage ratio is 14.2. For every $1 of interest payment, Daimler has $14.2 in earnings. That's very strong. And Kraft Heinz, that pays 5.7% in dividend yield, is a bad choice because the interest coverage ratio is only 4.5. For every $1 interest payment, it has only $4.50 in income, right? Not as strong as Nestle, 18.9, right? So from these two simple examples, you can understand why it's so important to look at the interest coverage ratio. So we want a company that has a high interest coverage ratio. We should also look at the historical perspective instead of just a one-year snapshot. Stockanalysis.com provides a lot of very good data. And when we look at Clorox, what do we see? Well, we see that the dividend yield ranges from here, slightly below 1.5 to 3.4%, right? So depending on where the bond yields are trading, this may likely to look reasonable. In terms of the sustainability, the ability to continue paying this kind of dividend, we see that the dividend payout ratio is about 60 to 70% max, right? That means that for every $1 of income, Clorox has paid out 60 to 70%, keeping the 30 or 40% in the company. So this tells us that it can be sustainable. In contrast, Bristol Myers script had been paying dividend from about 1% to 8%, right? And now about 3%. More important, if you look at the payout ratio, it's scary because there have been times when the payout ratio is 300%, 150%, 150%, 250%. What does that mean? Well, that means that for every $1 in income, over here, they have paid out $3 in dividend. How's that possible? Well, it's possible if they're using up their cash. It's possible if they're issuing a bond to raise money to pay this high dividend. And it's also possible that they are issuing new shares, use the proceed, some of it to pay this high dividend. So something like this, a conservative investor would want to do more research before buying this. They need to satisfy themselves whether this sort of very high dividend payout ratio can be sustained. Guru Focus provide us with more analysis. And here we look at Microsoft. This is the dividend per share history. And what we are seeing here is this dividend per share. You see that the dividend per share is rising here. And it's rather conservative when we compare it against the earnings per share. The earnings per share has been a lot higher than the dividend payment, right? So this means that the dividend payout ratio, right, has been rather low. Okay? And above all, the free cash flow has been growing very rapidly and significantly above what they're paying out in dividend. So there's a lot of cash that is not paid out to the shareholder. A quick look at the payout ratio will show you that at the highest point, it was paying about 80%. So for every $1 of income, they're paying out 80 cents in dividend. Right? So given the very strong free cash flow and earnings per share, this looks very sustainable. Chart will give you a more graphical representation of what to look out for. So I'm looking here at the dividend paid, these red lines here. They are a lot lower than the free cash flow and income statement. Right? So you see the same pattern every year. Every year you see the same pattern where the dividend paid out is a lot less. Right? So this is a very strong position. Microsoft has the ability to pay more if they want. And in fact, they did. On top of the dividend, right, Microsoft has enough money to buy back its own shares. An investor could look at the buyback yield and use that to add to the dividend yield. Add to the dividend yield. So you can see the total yield, right? 4.64 is a sum of 3.11 and 1.53. So instead of just looking at a dividend yield of 3%, 2.5, and 2, 1.86, and so on, if you look at the total yield, you see a much higher number, right? 4%, 5.9%, and so on. Okay, right. So the other research that you want to look at would be peer comparison. In this case here, we use the data from marketbit.com, and we are comparing JP Morgan with the other banks. So JP Morgan payout ratio 34.35, Bank of America 24.49, Wells Fargo very low at 9.13, Citibank 26.91. So we see that among these four banks, the payout ratio is rather conservative, right? Meaning that there is opportunity for them to increase the payout ratio or exercise more buyback. And looking at this, we can see that Citibank dividend yield at that time is 4.9%, a lot higher than JP Morgan. And the 3-year dividend growth rate, 357%, a lot faster than JP Morgan. So an investor who started looking at JP Morgan may be persuaded to change the mind and say, I now prefer to buy Citigroup, right? Because of the higher dividend, the rising dividend growth yield, and the lower payout ratio compared to JP Morgan, meaning that if Citigroup were to pay out a lot more, then there will be a bump up in the dividend payment.